Okay, so we're recording. So thank you so much, everyone, for joining. Welcome to another session of the My Community webinar series. And we have a couple of great special guests today. We've got Amanda Hahn and Matt MacFarland from Keystone CPA. So they've literally written the book on investing in real estate and podcasts. And so they're CPAs that specialize in helping people invest in real estate, which is obviously super interesting to our community because that's one of the top reasons that people are setting up accounts with us. So I'll let Matt and Amanda say hi and maybe give a brief introduction of themselves.
Well, thank you so much for having us here, George. And thank you everyone for joining us. We're really excited to be here to talk about the tax benefits of self-directed investing and more specifically, the differences of self-directed 401ks versus IRAs.
Yeah, thanks for having us, George. This is probably one of our favorite topics to always talk about, retirement strategies and planning around it and using real estate. So we're excited to be here.
Thank you so much. Yeah. So we'll just jump right in with the topic. So our hope is that this is, episode 1 of the Amanda and Matt series on our community. So we'll have you back to share additional knowledge with us on, all your great knowledge and experience. So, but for today's topic, we wanted to focus on solo 401ks versus self-directed IRAs. And as far as just a little housekeeping, if you have questions, please, we want people to bring questions and we can have a dialogue. We brought our own questions to kind of get the topics flowing. But if you want to post questions, please do it. The best way to do it is if you could chat them over through the Zoom feature so we can field them through the Zoom chat function, and then we can field it in an orderly fashion. If you're not able to stay for the whole session, the recording is going to be available on the private My Community webinar group. You can also post questions in the forums. I know Amanda and Matt are members of the community, so that's another great way if you didn't get a question answered or have a follow-up, et cetera, et cetera. So as far as the agenda, we want to talk about basics, of course, first, as far as what is a solo 401k, what's a self-directed IRA, the major advantages of the solo 401k, maybe when a self-directed IRA would be appropriate, some of the similarities and differences, et cetera. And then we brought some questions, like I mentioned. We should start out with the disclosure that the presentations being presented or being provided for educational purposes only and should not be construed as tax, legal, or investment advice. And of course, when making an investment decision, please consult with your tax attorney and financial professional. So I'll kind of try to guide us through the slides, but please, like I mentioned, jump in with questions, and Amanda and Matt, please jump in with comments. So as far as the basics, a solo 401k, and it's not always a straightforward question as far as who's eligible, but the way that I think about it is, a 401k is for an employer and a solo 401k is for a self-employed individual, so an owner-only business. There are exceptions for that. For example, you could have a husband and wife, a spouse business, but they can't have any full-time W-2 employees. In terms of, really the purpose of it, of course, is to save for retirement. So one of the advantages of the solo 401k versus some of the other vehicles out there is that, it has the highest contribution limits for any defined, contribution plan. Some of the names you might see, which is all really referring to the same thing. It's just marketing terms, right? You've got individual 401k, uni 401k, solo 401k. Some of the major brokerage firms offer their own plan and they use different terminology, but it's all referring to the same, quote, one participant plan. So, the 401ks, solo 401ks are a lot easier to administer. There's not as many requirements that apply to a solo 401k versus a full-time employer plan, right? Because you don't have non-owner employees that you have to worry about, like offering it to them, doing testing, things like that. So they're much more streamlined from a compliance perspective relative to those full-time employer plans. In terms of you know, again, the eligibility question, you could have a W-2 job, you could have as well as a side business, and you could use that side business to set up a solo 401k. You don't have to have an LLC. You could do it as a sole proprietorship. That's probably, for us, that's one of the top structures that our clients have. They don't necessarily have a formal entity for their self-employment activity, but you can. I mean, you could have an S corp, you could have a partnership. You know, and again, it goes back to contributions. Those contribution limits are much higher because you can make, in the words of the IRS, both employer as well as employee contributions. So it could go as high as 58,000 for 2021, or even 64,500 if you're 50 or older. I guess for Amanda and Matt, you know, maybe you could comment on how it comes up for you, and maybe some of the reasons why people are looking to set up a solo 401k. Like, do they hear about it from you, or do you mention it to them? Why do they want to set it up? Is it, maybe comment on that, please?
Yeah, you know, I think like Matt said earlier, this is one of our favorite topics because Solo K is such a powerful tool for a lot of, you know, small business owners as well as real estate investors when it comes to, you know, having a way to significantly reduce taxes. So, you know, take someone who's at, you know, one of the highest federal tax rates, plus, you know, maybe a high state tax rate. You know, we'll just assume it's a 50% tax, you know, tax rate for an individual. If they're able to use the product like a Solo K and contribute the maximum of $58,000 on the tax side, what happens is they could see an immediate tax savings, right, on half of that money in the form of cash. And because of the much higher contribution that's allowed, it's one of the great ways to help reduce tax burden for those who are, you know, having higher income. On the real estate side specifically, just kind of touching on what type of income is available. There's, you know, all types outside of real estate, consulting, sales, you know, all those things. But specific to real estate, the Solo K is great for realtors, you know, who are paid 1099 on commissions, brokers, lenders, also those who are involved in fix and flip real estate, and wholesale real estate. So all these that I just named off are considered active income, and those are the ones that are potentially eligible for this type of contributions.
Yeah, I mean, I think it comes up, right? It's, you know, you guys kind of touched on it, right? It's tax savings, ability to set aside money for retirement, and then, you know, also being able to use that money inside the retirement account to continue to invest in real estate. So it checks a lot of boxes for a lot of our clients.
Absolutely. Now, I know for us, one of the top reasons that people set up accounts is the Mega Backdoor Roth. Do you hear about that much, or is it, I know for us, it seems like it's more and more, there's a lot of scuttlebutt out there about how, you know, tax rates may go up. So, you know, put it in now as a Roth contribution, and especially the Mega Backdoor Roth, where you can get as much as that 58,000, for example, as a voluntary after-tax contribution.
Yeah, we're definitely hearing a lot more need for that, especially like you said, the talks of increasing tax rates. And the Solo K is a great opportunity because not a lot of employer 401ks offer that. You know, if you're someone who works for you know, Toyota or whatnot, not a lot of the company plans offer. And the Solo K is a great way to do that. I mean, we all know that, you know, for certain taxpayers, they can put, you know, 6,000 into the Roth, but the Solo K is just the backdoor allows a much larger amount to be stashed away for, you know, permanently tax-free growth.
Right. Yeah, we get a lot of calls. I know on the employer side, you're exactly right. But it seems like I noticed, you may have seen the articles about Amazon, how they allow the after-tax contributions for their 401k. So, you know, you might hear more.
I mean, I think the trend is changing for sure in the last couple of years, but it's, you know, which is nice to see because it does, again, gives that people the ability that have that cash and want to set it aside for retirement, gives them a vehicle to do so.
Yeah, no, it's amazing. I mean, you get in these people are just in sometimes, you know, they're just finding out about it, and it's almost like they're calling, like, is this really true? You know, because, you know, their experience is, you know, the 6,000 into the Roth IRA, and it's like, whoa, almost 10x that, 58,000, and it kind of blows their mind. So it's kind of fun. It could be a fun conversation as it washes over them, the realization. So especially if you have a husband and wife, right? Because you could each be putting that much money in, and you're getting
definitely.
over $100,000 a year. So yeah, pretty nifty. And then, like you mentioned, then, a lot of our clients, they know more about real estate than, say, the stock market. And so they've got the real estate as their self-employment activity that gets them eligible and in the door to have the plan. And now they want to use that money to invest in real estate because they feel like they know it better than the stock market, right? So
Yeah, I think, because our firm specializes in working with real estate investors. And so a lot of the, initial pushback we hear sometimes, right, for someone, let's say it's an attorney who's wanting to invest in real estate, but maybe made a lot of income from his legal work. And so when we say, hey, can you, between you and your spouse, you can put over 100,000 into the solo K and save on taxes. Sometimes the initial pushback is, well, that sounds great, but I really wanted to use that money for real estate investment, right? Which is why, I'm doing the planning. And so the whole, solo K, self-directed solo K is really great because it allows them to accomplish both goals. One, funding it for the immediate tax savings, but also at the same time using that money for real estate within the retirement account.
yeah, exactly. And it seems like a perfect kind of, because don't they say, for example, with real estate, that ideally you keep that investment for, say, 10 years in other words, it seems like a great type of investment that aligns with a retirement account, right? Where you're not going to be liquidating and et cetera. And ultimately it's going to have that positive. I mean, obviously there's no guarantees and all that good stuff, but just, from an educational perspective, it can be a good fit for a retirement investment.
Well, and you mentioned it too. It's the, what do you feel? What does the taxpayer investor feel comfortable with? Right. A lot of our clients obviously feel comfortable investing in real estate where they may not, because in the stock market, because they don't have any control over it, or they don't know a lot about it, or what have you. So it's just, for a lot of people, it's just the comfort level and the experience and knowledge about, hey, I know this investment class. So why don't I put my retirement in this in something I know, versus letting it quote unquote ride or whatever, on the stock market.
Yeah. So, and I guess from your perspective, as far as the type of services and support you guys provide, it would be helping them not only with their business taxes and their real estate investments, but also, the whole package, right? From both angles, I would imagine.
Yeah, I think, our role as the tax advisor really is to help an investor first figure out which type of retirement account is best for them, because not everyone is eligible for a solo 401k, right? As we talked about in this slide. And so determine what type of account makes sense for them, whether it's a solo, a SEP, a regular IRA. Figuring out, and part of that conversation is how much retirement contribution makes sense, and then we also kind of dabble in, if someone's looking to invest in a deal, what source of funding is the most ideal? Is it using, if they're looking at a syndication investment into someone else's apartment deal, for example, is it better to use their cash? Is it better to use their money from their IRA or money from their solo K? So that's kind of where the tax aspect of it comes in terms of planning.
Yeah, fantastic. Well, let's flip forward to the slides. This is like, we could talk for days on these topics, and we'd love to have you back to talk in more detail about some of those, because can be a complicated question. For example, on the eligibility point, we could spend 30 minutes just on that. But so to share some more of these slides that we put together. So the next one is an overview of the self-directed IRA. So self-directed IRA is really just an IRA, but it's going to have that ability to invest in alternative investments with checkbook control. So you can invest IRA funds into real estate. The nice thing about the self-directed IRA is there's no eligibility requirements. You just have to be an individual, right? It's an individual retirement account. There's no self-employment requirement, for example. You need to have, of course, taxable compensation in order to be able to contribute. but you can roll over money from a former employer plan. So if you've got an old plan out there that you just kind of haven't really done much with, you can roll that over to the self-directed IRA and then invest in things that you're more comfortable with. The contribution limit we've got it listed here for 2021 is 6,000 or 7,000 if you're 50 or older. So I guess maybe the question that I would have for Amanda and Matt is, maybe comment on when you see that it makes sense for your clients.
I guess a common example we see is, someone who's maybe built up a good amount of money in their work 401k, and then they're wanting to use that money into real estate rather than the traditional stocks, bonds, and mutual funds. And so the ways to get it out is either to do, maybe like an in-service rollover, or if they have separated from their previous employer, then they can do, just a direct rollover from Fidelity into a self-directed IRA account, and then from there start shopping, for real estate. There are also individuals who kind of just, really haven't contributed to retirement accounts in the past, so they kind of start out small with, 6,000 per year, letting that grow in the self-directed, and hopefully there's in a couple years there's enough to do some sort of real estate, rental property, or note investment. But I think the majority of the time we're seeing is people rolling money from maybe an employer plan into the self-directed account for real estate.
And that might be somebody that's not eligible for a solo 401k like we talked about. So
Sure,
they're looking to, the contribution limit, 6,000 per year is not as great as a solo 401k. But if they're not eligible for solo 401k, this is a great way, like Amanda said, to move money from an old work 401k into this, to have some more control over what you want to invest in. Because, obviously we all know with work 401ks, a lot of them, they give you quote unquote options to invest in, but it's,
right,
a list of 20 different things, right? So that's where kind of we see it a lot.
Definitely. Yeah, makes sense. Exactly. So now, as far as the advantages, we sort of kind of touched on some of them, but we've got a nice list here, especially compared to the IRA, right? You can take a loan, you got the higher contribution limits, you can make Roth contributions. Of course, you can make Roth contributions to an IRA, but they're much higher. You serve as the trustee. So one of the things we haven't touched on, but of course, when you have a self-directed IRA, the money has to be at one of these specialty trust companies. And then if you want to get the checkbook control, you need that LLC underneath it. So there's additional costs and structure associated with that. Whereas with the solo 401k, you can have it, at your local bank or at a brokerage where you have direct checkbook access to be able to act quickly on an investment. And then the one that we skipped over, going back to the second bullet, which is a little bit more of a technical issue, but if you're going to invest with leverage in real estate, using a 401k, there's an exception from a tax that would typically apply to the income attributable to that investment, which is UDFI. Some of the more, viewers that are a little bit farther along in their knowledge may be aware of that. So, but that tax applies. Essentially, there's a tax benefit, right? You're going to have to pay tax on income attributable to debt finance real estate inside of an IRA, generally speaking, whereas there's an exception to that tax if you do the same investment inside of a solo 401k.
Yeah, and I think, as real estate investors, leverage, just the whole concept of leverage is something that, is near and dear to all investors.
Sure.
And retirement investing is no different. If you have built up $100,000 in your retirement account, I mean, you can either use that to all cash to buy a rental property for $100,000, or you can use leverage and maybe buy, use $100,000 as a down payment. And, the retirement account could be buying a $200,000 or $300,000 property. And so I definitely think that's a major advantage that the solo K has. That, IRAs can also use leverage as well, right? But they are just more, maybe more, subject to the UDFI taxes, whereas the solo K doesn't have to worry, the solo K investor doesn't have to worry about that as much.
Do you guys get involved with helping file those tax returns to pay that UDFI tax? Form 990?
We do, yeah. So for our clients that are investing in leveraged real estate or they're investing in somebody's syndication deal with their IRA that has leveraged real estate in it, we do help them prepare the 990T forms each year.
Great. Yeah. Now, do you just no, for us, I mean, a lot of times it's because they're coming from, they know about real estate, and then of course, then they know about leverage. It sort of can be an education as far as the non-recourse concept, right? Because they might be coming in with a certain set of numbers in their calculation, thinking that they're going to be able to put X% down. And then they go and talk to the non-recourse lender, and it's like, oh, they got to rework their numbers because the non-recourse lender might want 50% down, right?
Mm-hmm.
So
yeah, that's something for investors to definitely be aware of, is that typically you got to put a higher down payment if your IRA is buying direct owned real estate, if it's going to get a loan, than you would if you were just buying individually in your own name. A lot of people can get 10% down, 20% down, 0% down for that matter.
Yeah, I always get the question too that, where do I find these lenders? And we don't have a list. I don't know if somebody, you as the, or the community, someone has a list. But yeah, that's a question we get all the time. Like, who do I go to?
We do
for
have a
these
list.
loans?
Yeah.
Oh, good. Okay.
Yeah. And we do have a list. And there's even going to be a non-recourse lender here this same time next week.
Awesome.
On the community. So to educate us on about that process. But yeah, exactly. That's a question that we get a lot. Do you happen to know, like, what's your sense? Does it seem like that your clients go more to private individuals, or do they go to those financing companies to get?
I think we've seen both. Private money as well as institutional. For bank financings, usually what we see are the smaller local banks, not so much kind of the national chains. I don't think I've seen that as much.
Got it. Okay. Yeah, interesting. So yeah, okay. So then let's see here. Next one is when a self-directed IRA. We kind of touched on this, right? If you're not self-employed, or even if you are self-employed, but you have employees working for you, right? That would be the other side of the spectrum. But you want to be able to invest in alternative investments, to hold former employer funds if don't qualify for a solo 401k, hold solo 401k funds once no longer self-employed, or Roth IRA, right? That would be another one. It's not in this not in this slide, but because obviously if you have money in a Roth IRA, you can't, and you want to self-direct it, you can't transfer it to the solo 401k. So you'd have to get that self-directed Roth IRA LLC to invest in real estate. So, okay, so let's see. We've got some more similarities. Both can be invested in alternative investments such as real estate. Both are subject to the prohibited transaction rules. Protection from creditors falls at the state level for both. Neither may be invested directly in your own business. That's for sure.
Yeah, this is I like this slide because that's a question that I think we get a lot. When people hear about the prohibited transactions, you can't buy, sell with yourself and the self-directed IRA. And so sometimes people are under the impression that then those things could be done with a solo K. So I like how, you have it on the slide that the rules are exactly the same. What you can do, what you cannot do are exactly the same in the solo K as it is in the self-directed IRA.
Yep, exactly. And that's especially like that can be an education process, especially if somebody is, having that real estate investing experience. Maybe they have historically worked on the property, right? If it's like a one-off property, and so they're like, well, I can do it. Why do I have to hire somebody else to do it? So that can be kind of a pill to swallow, but it's just part of the equation. There was a GAO report that I'll mention it sometimes. There was a GAO report you might remember that came out a few years back. It was about investing in retirement money in real estate. And they have a picture of a hammer with a cross through it. Like you can't use a hammer. So
God forbid you pick up a hammer,
Right, you can't pick up a hammer, exactly. So that's always a helpful image. Yeah, and then invest in your own business. Of course, you could do it indirectly in a way with the solo 401k, because you could take a loan, right? You could take a loan of up to 50% of the balance, not to exceed 50,000. You could do whatever you want with that.
Yeah, I mean, that's also a question that comes up a lot. Is somebody's, does a lot of fix and flips. They got a fix and flip business, and they want to use their retirement account to lend money or invest into their fix and flip business. And, we have to be the bearer of bad news saying, unfortunately, you can't do that because it's, that's a prohibited transaction, obviously. So, but they could clearly use their retirement account to invest in somebody else's fix and flip business if they wanted to, do something like that, but they just can't do it in their own business.
Right. Yeah. And then you get the question, well, what if I lend it to this person over here and then he lends it to my business?
We never get that question.
It's like A for creativity, but F for compliance.
Right.
That's always my response. But yeah, you could use the loan though. That's the one thing, but it's sort of like a one-shot deal, right? Because you have like some people will say, well, the bank will be my 401k. So I'll take the money for my future self and I'll pay it back. And I'll use this 50,000 for my own personal fix and flip. Like I own the property and now I want to fix it up with the money. So my bank will be my solo 401k, and then they'll pay it back. And then they'll come back 2 months later and say, I'm ready to do it again. But the problem, right, is that those multiple loan rules, because they have that 12-month look back period. So you have to wait 12 months after you paid back that $50,000 loan before you can take a second loan. So that's always kind of a question that comes up now and again, but okay. So more differences, the reporting, so the form 5498, that only applies to IRAs. We get that every once in a while asking if that applies to a 401k. The 5500 EZ, that applies to solo 401k plans once the value goes above 250,000. And then of course, and then we'll get the question, well, I've got less than 250,000 cash in my account, so I don't have to file, right? Well, it's like, no, you also have to include the value of the assets, like including the real estate. RMDs, Roth IRAs are not subject to RMDs, but Roth 401ks are once you reach the age 72. Termination, so when you terminate the plan, the solo 401k, and roll the money over to an IRA, the form 1099-R is going to be required, plus a 5500 EZ. Even if the value is less than 250,000, you still have to file that final form 5500 EZ. Of course, with an IRA, you just got the 1099-R. We kind of touched on before about the differences as far as holding the money. So with the IRA, you have to have it at that specialty trust company or custodian. Whereas with the solo 401k, under the rules, you as the owner of the business and the trustee can have direct access to the money. So I don't know if you guys have any reaction to any of these points, but.
No, I think that about sums it up. I think, for a lot of times people ask us if we issue the 1099-Rs, and usually we don't. I think it's the custodians are usually the ones who will issue those types of tax forms.
Do you guys get involved in calculating RMDs?
Yeah, we help clients with that. For the ones that are obviously it's applicable to, we can help them with that.
Sure.
Typically, the bigger institutions that, if they have a standard IRA at, I don't know, Vanguard or whatever, right? A lot of those institutions will help them calculate that as well too.
Here's one you guys might see is because I know you mentioned that you have folks that are invested in syndicated deals. Mm-hmm. So they might have a 401k, for example, that is getting a K1 from the investment provider. We know where the K1 is issued to the plan under the EIN of the plan. And then they'll say, okay, well, do I use that K1 value to determine is that the number I should use to determine whether I've crossed over that $250,000 threshold? And of course, the purpose of the K1 is to report the income, right, attributable to the investor. So it's not a reflection of the value of the investment. So that can be a common kind of FAQ that comes up in the context of a 5500 EZ, but so I don't know if you get that one, but that's always a fun one. So, all right, so we'll see again, if anyone that's here, again, thank you for participating. Feel free to chat over questions. We'll go through these questions. I'll pose the question and let Matt and Amanda field it. So the first one is, can I make solo 401k contributions based on interest I receive from my investments?
Yeah, that's a good question. Unfortunately, the answer is no, and the reason is the interest that you're making on your investments is not treated as kind of self-employed income, earned income, for lack of a better term. So a lot of times your contributions to a solo K are based on your, compensation if you get a W-2 from the business, or it's based on net profit from the business, but it's based on the self-employed net profit and not, side income like interest or something like that.
Yeah, I think for the vast majority of investors who make interest income, whether from a bank or a loan, like Matt said, these are just generally, investment income, which does not fall under this, self-employed or earned income. And that's why you usually cannot fund solo Ks based on that activity alone.
Absolutely, right. Yeah, exactly. The way I think about it is, of the purpose of a 401k is for employees to save for retirement, not for investors or owners. So you have to really have that earned income as a basis to be able to make the contribution. And so you can't take, when you have investment income, you're really making money off of money that you already had, right? Money that you lent to somebody, your money's working for you, but that's not the purpose of a 401k. It's not for investors or owners to save for retirement. It's for really employees, or in this case, self-employed persons. So, okay, can I borrow from my self-directed IRA? I can borrow from my 401k through my work. I would also like to take a loan from my self-directed IRA. Are loans allowed from self-directed IRAs?
Yeah, that's the issue, is that the IRA is different than the 401k. So you can take a participant loan from a 401k, but unfortunately you can't from an IRA. And as you put on the screen, that includes SEP IRAs, simple IRAs,
Roth IRAs.
Roth IRAs. It's just, you can't borrow from an IRA.
I think that's one of the main reasons why a lot of our clients really like the solo K. It's almost can be used as an emergency fund, right? Because kind of going back to the same thing earlier where we say, okay, someone made a significant amount of money doing fix and flip, and they want to shelter some of that income by putting money into a retirement account, but they might not necessarily want to part with all of that cash. And so one of the ways is to say, okay, well, if you fund it, you get a tax deduction. You can also consider a 401k loan and then be able to access some of that. And the loan that you access could be used for all sorts of stuff. There are no prohibited transaction rules surrounding what you use that loan proceeds for. Or some people just like to have that as an emergency. Maybe they don't need that money, but what if they did? What if things were to be bad? What if they needed to access some money? And it's just a peace of mind knowing, hey, I do have some money in my solo K that I could potentially borrow from in the event that I needed for personal or, other non-real estate reasons.
Yeah, those are great points. Yep, exactly. Now, what about do you hear much about the 60-day rollover, where someone will want to take it out as a 60-day and then try to put it back?
Yeah, we have people that we talk to about that. We have people who do that. You just have to be careful there. Obviously, there's sometimes things happen where you can't control the 60-day time period, right? Like, so it's set in stone. So if you're waiting for something to close in day 57, it might be kind of stressful, And the other thing to keep in mind with that too is that 60-day you're allowed to do once per 12 months.
Exactly.
And it's not once per IRA, it's once per all of your IRAs put together. And so it's not once per account every 12 months. We've seen people run into that issue as well.
Yeah, that's a kind of a nightmare situation we've seen more than once with people who, I don't know, just they didn't even know they had two different IRAs and decide to somehow to take money out of both of them. And that creates a major tax problem sometimes.
I bet, yeah. Yep. So, okay. Next one we brought is, can Social Security payments be used to make IRA contributions? I'm on Social Security and would like to save some of the payments in an IRA. Is this allowed?
I guess it depends on how you look at it, right? So, I mean, I know how you're asking the question. So it's Social Security payments are not considered earned income. So if somebody was trying to get taxable compensation to be able to contribute to an IRA, that wouldn't count as taxable compensation. But having, the other side of it is, if you have taxable compensation, it doesn't matter where the money comes from that you put into the IRA, obviously. So it can be from
Right.
Social Security, it can be from, other cash flow sources. But yeah, the way you're looking at the Social Security doesn't count as earned income for compensation purposes.
I hear you. Right. Yeah. I mean, so as far as if this is all you have, then you won't be able to make an IRA contribution. But if you have another justification to make the IRA contribution,
Right,
it's
exactly.
fungible. It doesn't literally have to come from like a certain, you don't have to track it to the dollar.
Right, exactly.
Yeah. Okay, good point. Yeah. Can I transfer my Roth IRA to a solo 401k? I'm considering using a solo 401k to consolidate my retirement funds. How do I transfer my Roth IRA to a solo 401k?
Yeah, you hit the nail on the head there with the answer. I mean, this is a quirky one that you would think you'd be able to take a Roth IRA and move it to a Roth 401k because they're both Roth money, but
Right.
it's just one of those quirky rules that the IRS just doesn't let you do that.
It's actually a terrible rule, and we always joke like we don't know why that rule exists.
If you want to find out why, write to your congressman, right?
There you go. Yeah, exactly. Take it up with your representative. So
yeah,
maybe they can sneak it into the infrastructure bill.
Right. Page 6,321.
There you go. Well, as far as definitely, we'll talk about next time in the community a little bit, but let's see if anyone has questions. Again, please don't hesitate to chat them over. So the plan next time is to get Amanda and Matt back to talk about investing in real estate using a solo 401k versus a self-directed IRA. So that'll be a great topic. I'm sure you have a lot to talk about on that one.
Yeah, and it's funny because I think, there's so many different things, when we say using retirement money for real estate, people sometimes just think of, one single family home, right? Whereas in reality, real estate investments in the self-directed sense can be all types of stuff. I mean, it could be just a regular rental property. It could be a commercial property. It could be a syndication, note investments, private notes. There's all kinds of variations that we see people get into. So it'd be interesting to talk about that. Yeah.
Yeah. Awesome. Yeah. And we put your contact information up here so that folks can follow up with you. So what's the best way? Would you say probably the phone number, the website?
Yeah, either one. Our website has a ton of great information, and we always try to put tax updates there as frequent as possible. And, in the next couple of months here, we are expecting quite a few tax changes. So definitely check out our website for, the latest and greatest.
Awesome. Thank you so much. Well, we'll plug the community. That's another place that folks can also post questions, and Matt and Amanda are members of the community, and we're looking forward to having you back for another one of these sessions to share more knowledge. So we really appreciate it.
Yeah, well, thanks for having us.
Yeah, thank you, George.
We'll see if we'll give it maybe another 30 seconds here to see if any question comes through.
Everybody's shy. Nobody wants to ask questions live.
They're supposed to ask the questions about their friend.
I think what next time we can do is get the questions from the community so people can post it beforehand. They can do it anonymously.
Yeah. Usually the members are not so shy. We usually have to say time's up, but but it was a great start, episode 1 with Matt and Amanda from Keystone CPA. We're looking forward to having you back. Thank you so much.
Yeah, thanks, George.
Thanks, George.
Okay, take care. Bye-bye.
Bye.
Bye.